So, welcome to today's presentation. My name is Peter Yusuf, Senior Market Analyst at IronFX. We're going to be going through technicals and fundamentals today, as always. And we're starting with USD/JPY. Now, USD/JPY practically suffered a double whammy, as we have mentioned yesterday. However, I have to note here that our expectations may have been realized behind the Fed's interest rate decision, the late American session yesterday, but that was not the case for BOJ. And we note how characteristically the pair USD/JPY rose yesterday and actually rallied during today's Asian session, something which comes into contrast with other currency pairs, which after the Fed's interest rate decision during today's Asian and early European session corrected, moderating the strengthening of the US dollar somewhat. USD/JPY continued to deliver more ground for the USD. Now, let's have a look on a minute basis, as we will be talking about the fundamentals. Unlocking the chart. This is the 1 minute chart. And this was the first hit. The release of the Fed's interest rate decision. It pushed the pair higher around 60 pips upon release and allowed it to rise even further in the following minutes, half hour. Now, the Fed's interest rate decision was to cut rates, as was expected, by 25 basis points, but that was not the market determinant. It was mostly the forward guidance, as it was provided by the accompanying statement, the new dot plot, the macroeconomic projections, and especially I would be highlighting here Fed Chairman Powell's press conference half an hour later. Now, the bank cut rates, yet overall signaled an easing of its rate cutting path. And I think that was something which tended to maintain support or enhance support for the US dollar that was across the board at the time of the release. And we see that later on with other pairs as well. I think that especially Fed Chairman Powell's press conference was somewhat more enlightening and more decisive towards easing the rate cutting path of the bank. Overall, we see the case for the Fed's interest rate decision to maintain or keep the US dollar supported, at least on a monetary level. On the flip side, I would be noting here that we had bearish market reactions for US equities. It was characteristic how the S&P 500 fell yesterday. And it's understandable in the light of tighter than expected financial conditions in the US economy. At the same time, I would be also noting that gold reestablished, at least for the release, its negative correlation with the US dollar and dropped. So, moving back to the USD/JPY pair, we had the first push, which was in the late American session by the Fed's interest rate decision. The second push upwards was practically by BOJ's interest rate decision during today's Asian session. The bank remained on hold, and practically its failure to hike rates tended to weaken the JPY, allowing USD/JPY to rise further. There were some conflicting messages. On the one hand, in the accompanying statement in its forward guidance, BOJ had highlighted that it sees the case for the CPI rates, the underlying in CPI rates, to actually continue to accelerate. or remain. So practically inflationary pressures are expected by the bank to remain in the Japanese economy. Now, that comment tended to highlight or keep the possibility of a rate hike in the January meeting alive. But in BOJ Governor Weather's press conference later on, there was some doubt on whether there will be financial conditions which could continue feeding the idea of a rate hike in the January meeting. And that's why I had mentioned earlier that we got some conflicting messages. Overall, in my opinion, I think that the release tended to set some doubt on the rate hike of January, the expected rate hike of January. And that's why it was more or less more tilted towards the dovish side, or if you prefer, on the bearish side for JPY. Back to the daily chart, let's have a look at the technicals. Now, definitely the pair has broken the 155.35 resistance line. We now turn this into a support line. And let's go hunting for a new ultimate resistance level. And here it is. At 166. I would like to have a look where it rests actually, on which peak. And we have to go way, way back here. Back to the monthly chart. Okay. Readjusting it. Back to the daily chart. And let's correct the levels. It goes back all the way to 1990. And that's an issue in the sense that practically shed some doubts, because if you accept that there were people back in 1990 which were willing to sell at that point, it's questionable whether there will still be people willing to sell at the same point today. That's one. The second element which sets the whole issue into, or let me rephrase it, the other element which tends to support the idea of the validity of the level is the historic data which could set doubt on its validity actually do not exist. There is no other peak after 1990 which could allow us to say that no, there's another peak which could be lowering or raising the bar for the R3. So we maintain that level. And at this point, I would be also slightly readjusting the resistance and support lines here. Widening the support lines practically. Okay, we start with the S3 at 147.10. The S2 at 154.30. Let's have a look at that. Yeah, 151.30. That's correct. And the 155.35 being the S1. There you go. Locking the support lines in. The R1, which is now being set at 158.35, 300 pips higher. The R2 at 162. And the R3 at 166, 400 pips high. Locking it in. I think it's clear that the upward motion of yesterday, and especially during today's Asian session as it broke above the 155.35 resistance line, now turned to support, was indicative of the bullish tendencies of the market for the pair. And hence we maintain a bullish outlook for the pair. I would be citing two issues here, small word of warning. The first would be the fact that the price action has broken above the upper Bollinger Band. That may slow down the bulls, if not actually cause a correction lower. One. The second would be the RSI indicator, which has not reached but is nearing very much the reading of 70. It's actually at 68.7. And that tends to imply that on the one hand, there is a strong bullish sentiment on behalf of the market for the pair, which could push it higher. However, it's nearing also overbought levels. And should it break above the reading of 70, the chance of a correction lower tends to increase substantially. For the time being, we maintain a bullish outlook. Anything above the upward trend line, which we have just shifted to the right, would be considered as a mere correction or further advancement. Should the bulls maintain control, I wouldn't be surprised to see the pair breaching the 158.35 and start aiming for the record high level of 162. It's a 34-year record high level, but practically it's record high in my opinion. For a bearish outlook, such an outlook currently seems to be remote. I wouldn't be adopting it, and for its adoption, I would require the pair to drop, breach the S1 155.35, breach the pre-mentioned upward trend line. That would be signaling practically the interruption of the upward motion, but also breach the 151.30 support level right here. So it has to drop below the S2. Okay. Let's have a look at Euro USD. Now, Euro USD dropped yesterday, actually tumbled considerably, breaking the 1.0470, but in contrast to the JPY, the euro seems to be resisting as the pair in today's Asian and early European session is correcting higher. For the time being, we definitely have to switch the S1 and turn it into a resistance line, given that the price action has moved below it. One point I would be makes me a little bit more happy is the fact that practically the downward motion stopped just short of the S2 1.0330. In my opinion, that actually verifies the level as a valid support level. So let's correct the labels, starting with the S3, which is now being placed at 1.0550, 0250. Let's have a look. 0.95. 0095. That's one. The S2 at the 1.0220. The S1 at 1.0330. The R1 at 1.0470. The R2 at 1.0660. Sorry, that should be, let's verify that level. 1.06, sorry. And the R3 at 1.0750. Now, on the one hand, I understand the urge for a bearish outlook here, but the correction of the pair during today's Asian session and early European session tells us otherwise. Definitely the fact that the price action broke in its downward motion the low Bollinger Band and may have been one of the contributing factors correcting higher. The RSI indicator dropped as low as the reading of 30. It's actually fell at 31, implying a strong bearish sentiment, but also corrected a bit higher. So there is still a bearish predisposition on behalf of the market for the pair. Should the bears regain control over the pair, I wouldn't be surprised to see it breaching the S1 1.0330 and start aiming for the S2 1.0220. On the flip side, should the bulls take over for bullish outlook, the bar is high. The pair would have to breach initially the 1.0470 resistance line and start aiming, if not actually breaching, a breach of the 1.06 R2 may also be required. Now, I would expect in a more long-term basis for the bearish outlook for Euro USD to be maintained. And I wouldn't be surprised to see that happening given that the monetary outlook divergence between the Fed and the ECB is widening. And that's not in Euro's favor. Also, I would be noting that fundamentally the situation in the Eurozone is worse than the US dollar, than the US, sorry. In the US, we have a rather stable government. Whether one likes it or not, that's not the matter. The matter is that there is stability. Actually, Trump's intentions to impose tariffs on European imports, on US imports from Europe, may enhance the bullishness for the US dollar and the bearishness for the euro. And lastly, let's not face that we are talking about a resilient US economy. While economic activity in the Eurozone is faltering, especially in Germany. It's quite worrisome. Let's have a look at GBP USD, given BOE's interest rate decision today. And definitely we have to turn the 1.2675 into resistance line, given that the price action has moved below it. Now resetting the labels, starting with the S3 at 1.2090, the S2 at 1.2295, the S1 at 1.2515, the R1 at 1.2675, the R2 at 1.2845, and the R3 at 1.3040. Now, with the Fed's interest rate decision out of the way, cable traders are expected to focus today on BOE's interest rate decision in the late European session. The bank is widely expected to remain on hold, and actually we maintain that as well. I would be focusing mostly on the bank's forward guidance, and given the latest employment and inflation data received earlier this week, which showed a relative tightness of the UK employment market and some resilience on behalf of the CPI rates, I wouldn't be surprised to see the Bank of England actually shedding more doubt on a possible rate cut in its next meeting, which could more or less provide some support for the pound and allow thus cable to breach above the R1 1.2675 and start aiming for the 1.2845. That would be reversing and actually mitigating the bearish effects for cable which were received yesterday. So I do tend to maintain a bias for the sideways motion of the pair between the S1 and the R2, with 1.2675 being practically mid-level. Should the BOE's hawkishness be a little bit more extended, we may see the pair even reaching, if not breaching, the R2 1.2845, with the next possible target for the bulls being set at the R3 1.3040. Now, should the market be taken by surprise by the Bank of England, and Bank of England insists and practically clarifies further that there will be a rate cut in its next meeting, then we may see the pound losing substantially ground, and that could cause GBP USD to tumble. In that case, we may see the pair dropping, breaching the 1.2515, with the next possible target for the bears being set at the 1.2295. Let's have a look at AUD USD, which should be falling. Oh yeah. We definitely have to switch the S1 into a resistance line. And let's go hunting for a new ultimate support line. Moving back. Okay, the validity of the S1 and the S2 stands. The second would be set at this true, and that would be the practically ultimate for the time being support line at 0.5860. Locking it in, readjusting the chart, and let's correct the labels. Starting with the R3, which is now being set at 0.6445, the R2 at 0.6365, the R1 at 0.6270, the S1 at 0.6160, the S2 at 0.5980, and the S3 at 0.5860. Let me verify that just once again. Yeah. The outlook remains bearish. In my opinion, though, you can see it already. A correction higher for the pair would be in the cards. And I'm highlighting this because the price action of AUD USD has broken below the low Bollinger Band. You can see how it's trying right now to refloat above it. The RSI indicator at some point broke below the reading of 30, highlighting exactly on the one hand the strong bearish sentiment of the market for the pair, but at the same time also highlighted how the pair dropped into oversold levels. Nevertheless, should the bears regain their confidence and control over the pair's direction, which could happen in the next couple of days in my opinion, we may see it breaching the S1 0.6160 with the gates being now then open for the 0.59 ATS2. On the flip side, for a bullish outlook right now is remote, actually very remote. For a bullish outlook, we would require the pair to breach the R1 0.6270, breach the R2 0.6365, breach the prementioned downward trend line, and in my opinion, also breach the R3 0.6445, with the next possible target for the bulls being set at 0.6555, 100 pips higher. So for the time being, such a scenario is very remote or would require considerable days to be realized. So we remain bearish for the time being. Having a look also at USD CAD, which should be flying, and it is flying. Definitely we will be switching this into a support line given that the price action has moved above it. Let's go hunting for a new ultimate resistance level. Probably we're talking about record high levels here. Yep. Back to the daily chart. Readjusting. And we're setting the resistance line sorry, at 141.48. Let's really correct the labels. Now overall, given the latest CPI readings from Canada, given the Fed's intentions, given BOC's, Bank of Canada's dovish intentions to actually cut rates further, despite easing its rate cutting path, I would maintain a bullish outlook for the pair. However, I would be also warning here a little bit more intensively the possibility of a correction lower. Nevertheless, as long as the upward trend line remains intact, we tend to maintain our bullish outlook. Another fundamental issue which may be more or less affecting negatively the loonie would be the, in my opinion, tightening of the fiscal policy of the Canadian government. Also, the intentions of US President-elect Donald Trump to actually impose tariffs on imports from Canada tend to weigh considerably on the Canadian dollar and actually, on the reverse, support the USD. On a fundamental basis, one could also mention the path of oil prices, but to tell you the truth, oil prices have remained relatively stable in sideways motion over the past month or so, and hence tend to have little, if any, effect on the loonie right now. Now, that should sum it up for the day. However, before we close, one small comment. We will be out of reach practically for the next 2 weeks, given the Christmas and New Year's holidays. However, I would like to issue a small word of warning here for traders. Be particularly on your guard if you're trading in those days. And the main reason I'm highlighting this is practically that thin trading conditions may apply in the markets. A high number of traders will not be at the desks right at those days. So we may see sudden abrupt moves in the markets which could cause substantial damage should you have open positions. Also, please do apply a stop loss level in case that one position turns sour, you don't get burned out. That should sum it up for the day from all of us here at IronFX. Best wishes for solid trading and a happy new year.
Okay, I guess we'll just go ahead and get started now. So, first things first, as per usual, a disclaimer. So, products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. A disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of material is strictly prohibited. Okay, so I'm Melanie and I will be your speaker for today's webinar on support and resistance. So here's our agenda for today. Firstly, we'll be looking at using swings for support and resistance levels, followed by looking at where exactly you should place your starting points. And then we'll be going into pullbacks and overlaps and combining these two in order to use these with Fibonacci as well. Okay, let's get started. So firstly, we'll go into how exactly you can use swings for support and resistance levels. So support and resistance levels in trading basically refer to prices at which an asset's price tends to stop falling, which would be your support, or stop rising, which would be your resistance. So to identify these levels, you can use technical analysis tools such as trend lines, moving averages, chart patterns, so on and so forth. Additionally, you can also look at previous highs and lows of the asset, as well as volume data to identify potential levels of support and resistance. So this is basically what we will be focusing on today. And it's important to note that these levels are not absolute and can change over time. So continuous monitoring is necessary. So I've added an image here for you to see how exactly we can use swing highs and lows as resistance and support levels, but we will go through it more in depth in the next few slides. So take note of how there are clear peaks and troughs in the market structure, and these areas can be used as your support and resistance levels. Okay, so firstly, let's look at an example of insignificant swings. So these are bad points to use for Fibonacci starting and ending points, but they're also not exactly good to be used for resistance and support levels. And I've shown you an example here in the GIF. So you can see that the um, price movements are really small and there's no significant swing highs or lows. Here's another example. So once again, there aren't really very clear swing highs or lows, and price movement is very small. Okay, and now let's take a look at a correct example of significant swings. So here you can see that there is a clear move up and down with obvious peaks and troughs and yeah, clear market movements basically. So in this GIF, that's basically what you are looking for when you are deciding on a chart to analyze on. So people may ask like which time frame do you use, which time frame do you recommend? And it's completely up to you. It depends on what kind of trader you are. So if you're a scalper, of course, a smaller time frame would be better. And if you are a swing trader, a longer time frame would be better. Okay, but still, when deciding which time frames to use, a important consideration is also the clear market structures. So you want to look for something like this, a clear market structure with significant swing highs and swing lows. Okay. Okay. So support and resistance. You can use these levels as take profit and stop loss levels, but you should not use it as an entry if there are no other supporting arguments, such as Fibonacci or other graphical levels to support your analysis. Using a recent swing high or a recent swing low is typically considered a weak level if it's just that level alone. So you can see in this GIF here, oops, in this GIF here, the recent swing high and lows, although they are significant, so you can see them very clearly, but they are not strong levels to use because we don't have additional Fibonacci levels to support them, and we don't have pullback or overlap support levels or multiple swing high or swing low support levels. So I'll show you what exactly I mean by that. So this is typically what you want to look for. So we're looking for multiple swings. So if at least two swing high or swing low levels line up nicely, these are typically much better levels to use. So you should try to find areas where these might line up, and it does not necessarily have to be at the exact same level because these tend to be areas more so than levels. So in this GIF here, you want to see how far you can, yeah. You want to see how far back your resistance or support line can go, and it's okay to cut through small wicks since support and resistance levels are usually in areas. Okay, so you can see here we have four swing highs that are about the same level, and we want to avoid cutting too many candlesticks. But if you're just cutting the wicks like in this example here, that's perfectly fine. Okay, so now that we know how to identify significant swings and use them as support and resistance levels, what are some things that we can look out for when inputting a support or resistance level? Okay, firstly, picking a starting point. So when picking the starting point of pivot, which is your entry level, support and resistance levels, these are typically your rules that you can follow. Hmm, Excuse me. So firstly, we want to check if there is a swing high or low, and we've gone through those in the previous slides. We also want to look for pullback or overlap levels. So if you are wondering what exactly those are, I'll get into those in the coming slides. Next, we want to go as far back as possible. So as you saw in the previous slide, I did mention we want to try and pull it back as far as possible without intersecting too many bodies of the candlesticks. So we want to avoid cutting the thick part of the candlestick and just the wick. So just the little sticks on top of the candles, those are perfectly fine. Okay, so the orange thumbs over here represent an okay intersection. They're not preferred, but not exactly wrong. But preferably, we want to look for intersections that are only of the wicks, like over here. Okay, some more examples over here. You can see this red thumb is what we want to avoid because it's cutting too many bodies of the candlesticks. So these green thumbs are what you typically want to look out for, where you are just cutting the wicks of the candlesticks. Okay, okay. Another example here. Um, Similarly, this red highlighted area, it's not preferred because you're cutting too many bodies of candlesticks. Okay, yeah, so the green thumbs, again, just cutting the wicks of the candlesticks. So something like this, would have multiple swing highs. We can just stop the support, or in this case, resistance. We can stop the resistance level just at this green thumb here. And it would already be considered a pretty significant level because we have three swing highs that line up nicely at the same level. Okay, which is important because you can see that price has tested this level many times before. Okay, next let's go into the pullback and overlap. Let me know in the chat if you guys have are aware of what exactly pullback and overlap level is before I show you guys the next slide. Okay, I think, yeah, because I do mention these a couple of times in our previous webinars, but no worries. Let's just go ahead and take a look at these. So firstly, we have pullback. So pullback, from the name suggests, we are expecting price to pull back to a certain level. Okay, so it's basically a strong level of support because it breaks out from a previous resistance level and price is now dropping back to visit it again. So in this case, we're just talking about the pullback support first. So if you take a look at the GIF, this is a pullback resistance. So just ignore that for now. Okay, pullback support is basically the opposite of that, where we are expecting price to retrace back to your support level. Okay, so a pro tip is when a pullback support lines up with a Fibonacci level, it's typically considered to be very powerful. For pullback resistance, these work well when it breaks a significant swing low and then starts pulling back to it. So it's even better, again, if there are multiple Fibonacci levels that are lining up with it. So here in this GIF, we have, okay, ignore the Fibonacci levels first because it is a little bit messy. But if, maybe I'll just refresh it. Okay, so here is our swing low for reference. Okay, so this is our swing low that we are using as a support level for now. But since price has already broken it and it's dropped below the support level, it's then a resistance instead. Okay, it's a resistance because we are expecting price to reverse off of that level. And that's why we call it a pullback resistance because we are expecting price to retrace back to the level and pull back to it. Okay, it is a little bit confusing, so let me know if you guys have any questions. But now if we talk about the Fibonacci levels. So here we are using a Fibonacci retracement. Okay, and I'm circling the 38.2 because it lines up nicely with my retracement. Once again, I have another retracement. In this case, the 61.8 lines up with my resistance, pullback resistance level. Okay, and now you can see that price really pulled back to our resistance and bounced off of it and headed downwards again. Okay, okay, maybe I'll just let you guys watch the GIF one more time. So price has broken out of the support level, the swing low support, becoming a pullback resistance. Okay, and now that the resistance lines up with not one but two Fibonacci retracements, it's considered a confluence area. That's why I've highlighted it. Okay, and yeah, you can see price reversing off of the level again. Okay, so confluence areas typically are considered quite important levels because you have multiple Fibonacci levels or moving average levels or whatever that line up with your support and resistance. Okay, so those are is basically evidence that price is likely to respect that level again. Okay, so here's an example. Firstly, I have three swing highs that line up nicely. Okay, at this area, this red highlighted area. Price breaks out of the resistance area and it moves upwards. Okay, moves upwards, and once it breaks out of this area, it's considered a Fibonacci, not Fibonacci, it's considered a pullback support. Okay, basically, when you have a resistance, once price cuts or breaks out of the resistance, it's then the opposite. So then it's a support instead. Okay, so then we call it a pullback support because we're expecting it to pull back or retrace back to the level, as you can see from the dotted arrows here. Okay, another example. In this case, we have a pullback resistance. In the beginning, we have three swing lows that line up nicely. Okay, so swing low, we would think of a support. Now that price has broken out of the support level, it's then a pullback resistance instead. Okay, so the pullback resistance, we're expecting it to retrace back to that level. Okay, another example here. So we have a significant swing low here over the circled area, and thus it is a possible support level. But now that price has pulled back and it has surpassed the swing low support, it is then a pullback resistance. Okay, so now let's see if price pulls back to this resistance level. And you can see that it actually did. Okay, so price has reached the pullback resistance level just as we expected. And once it reaches and reverses off of it, it will then be called a resistance, overlap resistance level. which is what I'm going to get into in a little bit. Okay. Okay. Next we have the overlap support and resistance. So an overlap support occurs when there are prices that touch the line from the top and from the bottom. So the more times that it reacts off of that area, the stronger the level is. So the reason for this is because it means that there are bulls and bears that are respecting that area, and therefore it's an important point to take note of. Okay, so once again, if your overlap area lines up with other elements such as Fibonacci or graphical elements such as your um, moving average or pivot points, for example, it will make it even stronger. So in this GIF, an overlap resistance happens when price touches it from the first point, which is over here, and from the bottom, which is here. Basically, when there is a swing low and a swing high that line up nicely in the same area. That's basically what an overlap level is. Whether or not it is a resistance or a support depends on what the latest where the latest point touches the line. So if it touches it from the top, it is a support. If it touches it from the bottom, then it's a resistance. Okay, here's an example. So the swing low support becomes a pullback resistance once price breaks the support at this 105.643 level. Okay, so you can see in this GIF how price retraced or pulled back to this resistance level and in fact reversed off of it, making it now an overlap resistance. Okay, so you can see here the minute that price, okay, here in the original image, price broke out of the swing low support. So once it breaks out of the swing low support level, it is then considered a pullback resistance. And once price retraces that level and reverses off of it, then it is a overlap resistance. Okay. Okay, let's move on. So now we're going to combine both pullback and overlap levels. Okay. Excuse me. Okay, so here we have a big swing high resistance level, okay, at the start, and price surpasses this level over here. Okay, so the moment price surpasses this swing high resistance, it now becomes a pullback support instead. Now, price has made a pullback to our pullback support and has bounced off of it perfectly. So once price bounces off of it, it then becomes a overlap support instead. Okay, another example. So we have two swing highs that are lining up. You can see these purple circles here, and we have a swing high resistance from this. So price surpasses this level here, it breaks out of it, and then becomes a pullback support. Number three, point three, price has pulled back to our support and has bounced off of it twice. So the blue circles is where price bounced off of it. So once price bounces off, it now becomes an overlap support. Okay, I think by this time you guys probably have gotten the hang of it. So this is just my last slide, and then we will take a look at some charts. Okay. So once again, combination of pullback and overlap. Firstly, we have a multiple swing low here. Okay, 1, 2 circles here. Point two, pullback resistance. Once price breaks the multiple swing low support, it then becomes a pullback resistance, and then it reverses, pulls back to our resistance, and reverses off of it 3 times here. Okay, so once price breaks out of this overlap resistance, it then becomes a pullback support once again. So every time it crosses the level, it basically switches from a support to a resistance or from a resistance to a support. Okay, and then point five, lastly, price has pulled back to our support and reversed off of it. So this level at the 33420, you can tell that it's a very significant level because price is continually retesting it. Okay, so what's important here is that because it's a pretty significant level, you can also expect Fibonacci levels to line up nicely with this level. Okay. Okay, now let me pull out my trading view and then we can take a look at some charts together. Let me know in the chat if there are any specific charts that you would like to see. Okay. Um, okay, here are my charts. Okay, if there are no specific charts that you guys would like to see, I'll just go ahead and maybe analyze gold first. Okay. Oops. Okay. Okay. So this is an example of a really clear um, price movement. Okay, so we have 3 swing highs here, and you can see really clearly the peaks here. Okay, okay. So we have a swing high, multiple swing high resistance here at this level. Okay, and we can see price um reversing off of it. Okay, and this is on our weekly time frame. So we like to look at higher time frames first so that we get an idea of what the general direction of price is on a zoomed out kind of basis, and then we can compare with the lower time frames after. So once again, I'm looking at this on a weekly daily time frame. Okay, and I can see that we have this decreasing trend line. So I think in our next webinar next week, we will be talking a little bit more about trend lines and trend channels, but I'll just briefly go through what makes um, a valid trend line. Okay, so what makes a valid trend line is if there are at least 3 touches on a trend line. And if it is decreasing, your trend line should be drawn, or rather, if it's a downtrend, your trend line should be drawn like this from the top. Okay, if it is a ascending trend line, then we can draw it like this, so from the bottom. Okay, but of course, this trend line is not valid because I don't have 3 touches on it. But this is basically what you are looking for a ascending trend line. Yeah, so sorry about my throat. The weather is getting cooler, so I'm feeling a bit under weather. Okay, so now let's look at the 4 hour time frame. So we typically like to analyze either on the 4 or 1 hour time frames, and how we decide between the two is like I mentioned earlier by looking at the chart structure, okay, the price structure. So you can see on our 1 hour time frame, it isn't really nice to analyze on. And the reason for that is because price movement is like pretty small. Okay. It's quite small. But if we look at our 4 hour time frame, you can see that we have much clearer price movements. So that's basically what we look for. Okay, so I'm gonna analyze this on our 4 hour time frame. Okay, let's see. We're gonna start off by identifying the trend. So we can all agree that this is a descending trend line, right? Or rather a downtrend. Now I'm gonna see if I can find any graphical analysis to support that. So I kind of have a descending trend line here. Okay. Now that I've done that, the next step is to go in with support and resistance levels. Okay, here is my my second support, second resistance, my first. Okay, I'm gonna see if I can find a closer resistance level. Okay, this level here is my first support. Okay, and then my first resistance, maybe here. And then my second support just here. Okay, so maybe just a recap. So my second resistance, I have a swing high here and a swing low here. So it makes it an overlap level. And then I also have another um swing low here. Okay, so I have bulls here and bears, both of these areas respecting my second resistance. So it's a pretty significant level, and that's why I have labeled that. Okay, and my first resistance, I just have a swing high here. Price has kind of broken out of these levels. Okay, so that's I only have a swing high level here. Okay, and that's the reason why my next step is to go in with Fibonacci levels to try and support these levels a bit more, or adjust them and see if I have any better levels to use. Okay, first support is because it's the closest swing low to where price is currently at. Okay, and it also respects a couple of swing highs and lows. Okay, second support, the reason why I put it there is because we have this swing high here and a couple of swing lows here as well. Okay. Yeah, and it's also basically the closest level to my first support. Okay. Now let's go in with our Fibonacci levels. Okay, so here I'm using a Fibonacci projection. Okay, and for Fibonacci projection, we use these three levels, and we use the tool Fib extension. Okay, that's on TradingView. If you're looking at MT4, I think it's also this symbol, but I don't think it's called an extension, but it basically has 3 points for you to analyze. Okay, and for Fibonacci X projection, just to recap, if you weren't here for our Fibonacci series, we look for a flash a flash or like lightning bolt kind of shape. Okay, something like this. Okay, here, even though you can see my 78.6 lines up nicely with my first resistance, this is no longer valid because price has already broken out of the level. Okay, so I'm just going to keep my 100% here. That lines up with my first support. Okay. Um, mm, okay. Here I can see that this Fibonacci retracement lines up with my 61.8. The 50% is no longer valid because price has already broken out of it. Mm, yeah, so just my 61.8. Okay, and this is a retracement. So for retracement, we use the 5 levels that I was using earlier: 23.6, 30.2, 50%, 17.6, and 61.8. Okay, I think that's all the levels that we have here. Okay, I think that's all the levels we have for Fibonacci. So the next step is to go in um with some indicators, and my favorite indicators to use are the Ichimoku and the MACD. For Ichimoku, I like to just look at the cloud, which is just the plots here. Okay, because if you look at all of the lines, which you can as well, but it is a little bit messy. Okay, so I like to just look at the clouds because at one glance, you can see exactly what the signals are. So if price is moving below the Ichimoku cloud like it is here, price is moving below the Ichimoku cloud, so it is a bearish signal. Okay, so it supports our analysis that price is likely going to continue to drop from the first support down to the second support. Okay, um, but over here, our MACD is giving us a bit of a bullish signal. You can see from the green here. Okay, and the reason for that actually could be because, as I mentioned earlier, our first support is here. Okay, and it's a pretty significant level with the swing highs, the swing lows. So it's an overlap support, and we can expect price to come back and retest this level, which is doing now, as you can see. And on top of that, we also have this 100% Fibonacci projection. Okay, that has not been um it's not been surpassed yet. So we're still seeing price test this level, but because of the downtrend from this descending trend line, we saw on the daily, the weekly timeframes that price is still pretty bearish on those levels, on those timeframes as well. So we can expect price to continue to drop towards the second support because of all the downward pressure. Okay, but for now, it is still testing our first support. Maybe we can use another indicator. Okay, let me know in the chat what indicators you guys like to use. Okay, I like to use these three. Okay, on our RSI, we're also seeing a decreasing trend line, so it's also supporting our bearish signal here. Okay, let me know if there are any questions. Oops. Okay. If there are no questions, I think we still have time for one more chart. So if you guys don't have any requests, I'll just go ahead and do um, maybe the Aussie dollar because we recently saw the RBA releasing a cash rate statement. So let's take a look and see how price affected the charts there. Okay, so same thing, I'm gonna analyze this on a weekly chart. Okay, um, let's see. Yep, we have a descending trend line on our weekly time frame. Okay, next, if we take a look at our daily time frame, also descending trend line here. Okay, remember the three touches here. Okay, next on our 4 hour time frame. So once again, I'm deciding between 4 or 1 hour, but both of these charts seem to be pretty clear. Um, maybe I'll just go ahead and analyze this on a 4 hour time frame. Okay. In this case, I don't really have a descending trend line, I think. Yeah. Let's see. Okay, I don't really have a descending trend line here. Okay, but we can definitely see that the trend is downwards. Okay. Now, I'm gonna go in with my support and resistance levels. Okay, this is my first resistance and my first support, maybe just here. And my second support here. Okay, now we'll go in with some Fibonacci levels again. Hmm. Okay, we don't really have very nice levels here. Okay, my 100% level lines up with my second support. Let me see if my 78. Okay, it lines up, but it's no longer valid because price has already broken out of it. Okay, so just my 100%. Next. Okay, I think my 38 lines up, yep, with my first resistance. Um, Okay, my 61.8 also lines up with my second support. Okay, so you can see here I have a confluence lab area here. Okay, so what I am doing here is I have recognized this Nike tick shape. So it's upside down, but this is the shape that I'm looking at. Okay. Um, yeah. So for this, we are using the Fibonacci extension tool. So it's the same retracement tool, but instead I'm looking at the 127.2 and 161.8. And I can see that both of these levels line up with my second support. Okay, and I feel like that's one of the reasons why you can see this reversal of the first support here. Okay. Okay, now let's pull out some indicators to support our analysis. Okay, price is moving below the Ichimoku cloud. So it's giving us bearish signals. MACD is also giving us a bearish signal, so we can expect price to continue to drop because of all the downward pressure. Once again, our indicators are also supporting this. Although we are seeing this rebound off of the first support, as I explained earlier, it's likely because of this 127 and also because of the release of the RBA cash rate. Okay, but yeah, there's a lot of downward pressure, so you can likely expect it to continue to drop towards our second support. Okay, confluence areas also tend to have confluence areas also tend to attract price. So we can expect price to reverse off of it, but we are also expecting price to be attracted to this area. Okay, so areas like our second support, where you have the 100% Fibonacci projection, 61.8% Fibonacci projection, and this huge swing low here. So we can expect price to continue to drop here. Okay, any questions before we go? You have to include the wick in swing high and swing low in putting resistance and support. Um, for Fibonacci, I feel like it's good practice to include it. But for support, swing high and swing low and putting for resistance and support levels, it doesn't really matter because as I mentioned earlier, it's more so levels, areas rather than levels. So you can see here, even though I didn't include the wick here, right? Okay, let me zoom out. But you can see I actually highlighted this area here because of my Fibonacci levels that line up nicely. So for these support and resistance areas, I am expecting them to be areas more than levels. So yeah, it doesn't really matter for support and resistance levels. Okay, I hope that answers your question. Okay, any other questions? Okay, if there are no other questions, yep, no worries. Thank you guys so much for joining me today. I hope you guys found this helpful. And for part two, I'll see you guys next week. Thanks, everyone. Have a great rest of your week.